we are answering all your tax queries related to buying, selling and investing in real estate. Let's take an email query next. Jalal has written in. He says he owns a home in Mumbai and wants to buy another house. Now he plans to sell his current home and invest 50% of the amount in a new house. He plans to keep the remaining 50% of the amount in the bank. Now he wants to know about the tax impact on the same. Ashish, this sounds like some retirement planning going on over there. What is the tax impact if he keeps money in the bank?
Right. So for the 50% amount that he wants to reinvest, since he's going to buy another residential property, the 50% can be reinvested within 3 years into a construction or residential or a purchasing of a residential property, and there should not be any tax on that. The remaining 50%, he has the right to keep that 50% in a bank account, and he can show it in his books as the money that he has received from the sale, the capital gains. He has the ability to use this 50% amount in the next 3 years for purchasing or constructing a residential property. He can put money in the property that he has already purchased or is constructing, which is the residential property. But if he does not utilize this 50% in that, then the 50% becomes taxable as capital gains.
So 50% will become taxable as per capital gains. And how much tax would you have to pay on that?
So if it is a long-term property, I assume it will be long-term property, it will be 20%.
20% is what you'll have to pay. However, like I said, it does sound like he's trying to do some kind of retirement planning over there. What are the other options where he can actually save on capital gains? What other instruments can he probably
So, in fact, in his case, when 50% is being utilized for purchasing another property, the remaining 50%, if it is within the 50 lakh amount, he can purchase it in long-term bonds of the government, which would again be tax-free.
Long-term bonds of the government, which would be tax-free. I have another problem with this question. Now, Jalal says that he's going to take the money that he's getting out of the sale of his house, invest 50% in the property, and put the remaining 50% in the bank. Now, the entire 100% will not be capital gains.
Right.
Right. So, could you just break down for Jalal and for all our viewers what capital gains tax exactly taxes?
Sure. So, let's assume that when Jalal bought the property, it was for 50 lakhs. Today, when he is selling it, it is for 1 crore. So, the cost of acquisition minus the sale price minus the cost of acquisition. So, therefore, 1 crore minus 50 lakhs, that is 50 lakh of rupees that he is making is the capital gains. And the tax needs to be paid only on the capital gain of 50 lakh rupees. So, out of that 50%, that is 25 lakhs can be reinvested without payment of any taxes. The remaining 25 lakhs can be invested in long-term bonds, on which again he will not have to pay any tax.
Right. So, Jalal, that's the breakdown for you. Capital gains essentially means the profit that you earn by selling property. To make it simpler, in Hindi we call this munafa. So profit or munafa that you earn when you sell property is what is being taxed over here. It is not the entire sale proceeds, or it is not the entire money in hand that you get after selling property. So it is essentially that portion of the money which is being taxed, which you have to reinvest in a residential property or in capital gain bonds to ensure that you save on taxes.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.